Hello and welcome to the Crypto Beat. My name is Tim Copeland and I'm the blog's editor-in-chief. Joining me today, we have Marc Zeller, founder of the Aave-Chan initiative. Welcome to the show. How's it going?
Always good. Thank you for the invite. It's always a pleasure to participate in high-quality podcast.
Awesome. All right. Well, before we get started, just a quick note that if you are hiring crypto, you should check out our new product campus. Out of all your candidates, it will help you pick out the real crypto natives. Head to theblock.co/campus to get a 3-month free trial. Now, today's episode is on the Aave ecosystem, and we have an Aave expert on the show. So before we get started, just for context, what is the relationship between Aave-Chan initiative, the ACI, and Avara, the developers of Aave?
So Avara is formerly known as the Aave companies, and that's the company I was part since 2019. This is basically day one of Aave. And it's not the actual beginning of the Aave ecosystem adventure, because in 2017, the founder, Stanley Kuleshov, created Ethereum and did an ICO to finance a peer-to-peer lending protocol. It was a first success in being pioneer in DeFi, but did not found product market fit. It was the right idea, but a bit early, like 2017-18 was not the ecosystem we have now in crypto. And basically in 2019, the initial team, so our Aave companies, decide to pivot from peer-to-peer lending to peer-to-pool lending, which was a model that was initiated by Compound back in the days in 2019 as well. A bit, I think, end of 2018, if I get my date right. And I joined the team to prepare for this transition and this pivot from Ethereum to Aave, and my role was the head of developer relation and the head of integration. So I'm the one that brought the first technical documentation of Aave v1. I did most of the BD, and I led the integration of Aave as an ecosystem and as a protocol in the full EVM ecosystem. The Aave story was a success. I think that's something that is factual at this point. And we had from day one this idea of decentralizing the protocol and the governance of the protocol as much as possible. It's very hard and almost impossible, I believe, to have a completely decentralized project at the beginning. You need to have a few people looking in the same direction and a concentration of the decision making, at least in the beginning. But reaching 2021, 2022, we reached the scale and the revenue and the product market fit for the Aave protocol to say, okay, it's not going to be a centralized team taking all the decision anymore. That's going to be the token holder. That's going to be the DAO, the decentralized autonomous organization that is led by the Aave token, with the core ethos and principle that if you own the Aave token, you own the Aave protocol. And that's something that we build and that we've been, I think, one of the main motors in the Aave ecosystem to do this aggressive decentralization and give power back and decision making power back to the token holders. So I spin out from the Aave companies to create my own company, the ACI. And instead of being an employee of the Aave companies, I became the founder of my own service provider. And I'm paid, and my budget is approved by the Aave governance for the past 2 years. And instead of having just one company, Aave companies, we got a rebrand, and Avara had the opportunities to focus on multiple ventures at the same time. So when we launched the ACI and decided to focus 100% on Aave, Avara decided to also spin out and have Lens, which is a social media Web3 protocol. They also did an acquired operation to launch the Family Wallet that is released. They have the Lens chain now, and they also have a set of other products. And the Aave DAO now works exclusively with service providers. So we decentralize the risk aspect with 2 teams, Chaos Lab and Llama Risk. We decentralize business development with ACI, strategy and governance coordination. We also have core development that has been decentralized with BGD Labs, former core developers of the Aave companies, and spin out from there. Aave still work on the protocol, but they work on long-term developments, such as new version of the protocol. So they designed the initial version of V3, and then BGD Labs did 3.2, 3.3, now 3.4. They do the maintenance, and they are working right now on V4, which is the expected new version of the protocol that is about to release this year.
And recently, ACI put forward, and I quote, "the most important proposal in our history." What was this proposal, and why was it so important?
It's a very important proposal for us because it's our promise we did to the community a bit more than 2 years ago when we launched the ACI. Our objective and our goals, our milestone were to grow the Go stablecoin, and I think we will discuss how Go is important in the Aave ecosystem. Make the product and the Aave protocol profitable. So when we launched the ACI, it was right after FTX event, Celsius, 3 Arrow Capital. Like DeFi was not in a good place back in the days, and the protocol was losing $35 million per year. Now we are at the end of 2024. We made as a DAO 120 million profit in the year 2024. So we are in a much better situation now. So the protocol is profitable. The protocol pay for its own bills with all the service providers that are employed. And even with this spending that used to be covered by the Aave companies in the early days of the protocol, now fully covered by the Aave DAO, we still have excess revenue. And those profits, we need to our promise to the community was to redirect that back to the Aave token holders and especially stakers that are willing to protect the protocol in the old system of the safety module and are willing to stake within the ecosystem with the new umbrella system. And the way it is, in a few words, is that we're gonna, for the next 6 months, that's the proposal. It has been voted on Snapchat and will be through the AIP stage probably today or tomorrow, depend on technical revenue, to acquire on secondary market $1 million worth of the Aave token in order to refill the ecosystem reserve of the protocol. And that's something we promised 2 years ago, and we are about to fulfill as a promise. So that's very important for us.
Yeah, there's been lots of suggestions that sort of like DeFi is dead or it's sort of been struggling for like the last few years. What would you say to that, considering how much money Aave made last year?
There's always like a segregation between the social discourse on crypto Twitter and the factual reality you will find on Token Terminal, on the block article research, or DeFi Llama data. Because when you look at the data, DeFi is actually in a good place, and especially Aave. Aave is now number one, regardless of the metrics you are looking to check it. Pure TVL, net deposit, active loans. We are number one on every single metric. We are almost at $30 billion TVL. The market is not helping the past few weeks, and I think the macroeconomy is also contributing to that. But if you look at Aave deposit, for example, or even DeFi in general, and you label that in the ETH currency, so to have some kind of tracking of the amount of net deposit in the ecosystem, you will see that the curve is like showing a clear growth, and it's not stopping anytime soon. What is also interesting is that the revenue is growing, and the source of revenue is growing. Is growing in terms of diversification. So we have more and more. Like last cycle, DeFi revenue was very linked to the interest rate of borrowing stablecoins. Now we have many other sources of revenue, especially in the Aave ecosystem. We have SVR, the partnership we have in Chainlink for the liquidation. So we take back the MEV back into the protocol revenue. We have leverage staking that was not a thing before the merge. And since we switched to proof of stake on Ethereum during the last cycle, we now have a delta neutral source of revenue. Obviously, the revenue itself is ETH, so it's affected by the market, but it will not be affected by the interest rate of borrowing stablecoins. So I have the feeling we are in a much more mature place right now. And on top of that, this cycle is where the institutions are coming. We got the ETF, and we have more and more institutions willing to dip their toes on chain, which was absolutely not an option during the previous administration, and it's becoming more and more a reality on chain now.
You mentioned about disconnect between crypto Twitter and sort of like the data. I guess it's probably partly because crypto Twitter is very sort of focused on the token prices and on trading. And like, for instance, if you look at the Aave price, it's still sort of down from the sort of highs it was in 2021, despite the revenue picture being way better now than it was then. So I guess like, this proposal could be partly to help the token price perhaps align a little bit more with the success of the proposal. And specifically, it's buying $1 million per week for 6 months, so roughly some sort of $26 million. What would the platform be doing with the tokens?
It's going to go back into the ecosystem reserve. So the way the Aave tokenomics were designed back in 2020, so 5 years ago, is that a part of the token supply was attributed already to the stakers as a revenue, because we knew it would take a bit of time to have actual revenue to make the protocol sustainable. Now we reached that tipping scale. So basically, for the past 5 years, we had this big bag of Aave, part of the token supply, that was attributed to the stakers, and the stakers were earning an Aave revenue, but that Aave revenue was emptying a reserve over time. And if nothing was done, 2 years from now, that reserve will be empty, and then we have nothing to distribute back to the stakers. So it was not sustainable. But now we are in a very comfortable position, and we are the only one basically in DeFi. I think Sky will be like another one that can be compared to us. But except both of us, we are the only one in the ecosystem where we have the ability to compensate every single Aave that is distributed back to the staker by the buybacks we do from the excess revenue of the protocol. So now we are in an excess situation because the Aave price is the current price. If the Aave price overnight is $1,000, obviously we will need the revenue to pick up in order to maintain that sustainability. But at least we are in the situation where the size of the ecosystem reserve and the reserve of tokens in it is directly linked to the economic activity of the protocol, which is, I think, a comfortable position to be in. I'm not very used to discuss the token price, but what I can say about it is that it's currently 3x what it was during the previous bear market. And the thing is that all token price are affected as an ecosystem. So I have the feeling that DeFi in general, I'm not talking only about Aave, is affected by the underperformance of the ETH ecosystem and the ETH token as well. So that's something to consider as well. You never live in a vacuum, and you're not just an island not affected by the rest of the economy or the on-chain economy more precisely.
So with the buybacks and giving the tokens out to stakers, do you think you can achieve some sort of equilibrium?
At the current token price, that's not an equilibrium, that's an excess. We're gonna buy back more Aave than what we're gonna distribute to the stakers at the current token price. We designed the Aave-nomics to be sustainable until I think where we designed that a $400 Aave price. We are 150 right now, so we have plenty of margin. But I mean, my guess is if the Aave price go up, that also means that the revenue has gone up as well. Because I want to believe there's like some kind of relationship between the actual economy of the protocol and the value of the asset.
Why don't you have it directly linked where, for instance, if the protocol generates a certain amount per year, a percentage of that gets allocated out to stakers, so they don't get like a fixed return, but they get a proportion, and therefore you sort of know that it's always going to be a certain amount.
So the way it works right now, it's a Cinnamons per day. But the budget is fixed for now because we are an extremely conservative protocol. Everybody knows that. The whole meme just use Aave is because we are conservative about the security. We are conservative about the safety of our users, and that's something we are extremely focused on. And we are also conservative of our budget. So right now we are in the process of approving the with governance, a $26 million budget into buybacks, 52 million per year, because it's very likely it's going to continue after the 6 months period, where our revenue is 120 million and the spending is 35 million. So you can see we are spending way less than the XX revenue because we are conservative, and we expect that the current year will be a bit complex in terms of revenue because the current market is a bit shaky in terms of global economy. So we want to have a large buffer, and we want to have a large treasury to make sure we never. I don't want to be in a position where we have to go to the forum tomorrow and say, okay, we taper the buybacks, or we stop the buybacks because it's not sustainable anymore. So I prefer that we under deliver in terms of buyback, at least at the beginning, than that we are like promising something that we cannot keep forever.
The proposal also reclaimed $65 million of unclaimed Aave tokens for the ecosystem reserve. Would that also be used to go out to stakers?
Yeah, that's something that is always difficult because you want people to have the ability to claim the token no matter what. But it's always like a risk-reward ratio, and always a question of balance. We opened, so when I say we, it's the DAO, we opened the migration from Lend, the legacy asset of the Aave protocol, to Aave 5 years ago. And the thing is that the migration was completely open, and we discussed about the end of the migration for the past few years, and people had 5 years to migrate their legacy Lend token into Aave. And we start discussing the actual end of this migration in the time check part of the Aave-Paynomics that was published 7 months ago. And even now, we are saying, okay, this proposal, we will not cut the bridge. We will give it another month. So 8 months of head start into a 5 years window where we discuss that on it. We have the feeling that we given a reasonable time and notice to every legacy landholder to migrate if they want to. Maybe people lost their key, maybe they lost interest or whatever reason. The land is stuck at this point, and it's time to move on and to put those assets into productive use.
Yeah, it's certainly a longer claim window than some airdrops that we've seen.
Yeah, most airdrop is like 30 days.
Yeah. Okay, with the new proposal, how are you planning to optimize liquidity incentives? Like, there seems to be a bit of a change there.
That's a very important topic. So there's two different things. The first thing will be to optimize the safety of the protocol. So the proposal of the Aave-Paynomics is converting the legacy safety module to Umbrella, which is the new self-protection system of the ecosystem. And the way the legacy safety module worked is that we have a bunch of Aave staked, and the ability to seize the Aave, sell it on secondary market to collect asset to basically cover bad debt if bad debt existed. That was a very theoretical system because we never had to use it for the past 5 years. And I truly believe and I wish we still not going to need to use any kind of safety module for the next 5 years or even forever. But the point of the protection system is to be here, even if you don't need it. The new system will allow people to directly stake their A tokens, so AUSDC, ETH, so they are deposited within the Aave protocol. So people will trade off their ability to be liquid in the Aave ecosystem. So they will commit to deposit liquidity for at least 20 days. They will renounce to be protected compared to the other users, and they will renounce to their ability to borrow, which is from our data. The data we have, 80% of the Aave user provide liquidity, and they are looking for a yield, and they are not looking to borrow. Like only 20% of the Aave user, in terms of active address interacting of the protocol, have actually a borrowing position. So for this trade-off, they will get extra yield and rewards that comes directly from the excess revenue of the protocol. So the way Aave works is that when people pay interest to the Aave protocol, 85 to 95% of that money goes back directly to the people providing liquidity into Aave, and the rest goes back to the DAO as revenue. And because the revenue exceed largely the amount we need for buybacks and the amount we need to cover the fees of maintaining the protocol through service providers, we have this buffer that we can send back as a safety protection system. So instead of spending Aave that we do right now, we can directly incentivize depositors that are willing to lock through the umbrella ecosystem, umbrella safety scheme. And that will give them extra yield. And because those users willing to lock and protect the protocol are a subset of all liquidity providers, even a smaller incentive in terms of budget will have a deeper impact in terms of actual yield gained by the protocol. So I believe, and especially, I'm actually convinced in the current market environment where the interest rates are quite low and the supply rate are quite low, that the umbrella stakers on Aave will have the best yield they can find, the best risk-adjusted yield. That's already what they get on Aave, but the best yield they can find on major protocol on-chain, directly providing liquidity on Aave. So that budget will be a subset and a percentage of the revenue we get on every single pair we have for this one. Was that clear?
Yeah. And what is the new umbrella safety module, and how does that work?
That's exactly what I described.
Yeah. All right.
So it wasn't that clear. So maybe I can. That's something that is important to realize about umbrella is that the 0 to 1 innovation on this system is that because the assets that are staked are directly the user deposit. If in a protocol, what the worst that can happen to a liquidity protocol or a lending protocol is that the liquidator don't show up. So every position is over collateralized. I have $120 worth of ETH, $100 worth of USDC debt, and my ETH goes down in value to $110, let's say, and my position is up to liquidation. So I have a $10 buffer between the value of my collateral and the value of my debt. So someone can show up, anybody in the world, say, okay, this is 100 USDC. The user doesn't have that. Give me back 105 or 108, whatever is the liquidation bodies to do that. Give me back that. And the user doesn't have that anymore. The protocol is protected, and whoever landed USDC on the protocol is sure he can withdraw. If we are in the situation where the ETH price goes down too fast, and now we are, for any kind of reason, when a liquidator show up, the value of the collateral is $95, but the debt is $100. Nobody will. Liquidators are not charity. They will not take like a 5% debt on that. They will liquidate what they can, and they will leave what we call the bad debt, so the remainder debt. So in all the protocols, they don't have self-protection system. So they pass this bad debt to all the LPs and say, okay, you had $100 in Euler, now you have $99. That's it. That's the cost of doing business. Sorry, but that's how it works. On Aave, it doesn't work this way. If there's a liquidator that doesn't show up, the protocol itself will protect the LPs. So with Umbrella, the people that deposited and stake USDC will lose part of their USDC. So the other LPs that didn't choose to stake will have their position protected. So they had $100 and they leave with $100 regardless of the bad debt in the protocol. That's the new Umbrella system. And because the asset that is collateral in the staking is the same asset as the LP, you can do basically accounting. So you destroy the claims. So a token is a claim to withdraw from the protocol, from the pool of assets in the protocol. So you destroy the claim from the stakers in order to make sure you have sustainable reserve for the claims of the non-stakers. So it's extremely efficient, and you don't have any slippage. You don't have to care about secondary liquidity. You don't have to care about liquidators of this kind of stuff. So liquidators are the first line of defense. They worked all the time, like for the past 5 years, but sometimes we had, out of $30 billion of deposit, we had $3 million over 5 years of bad debt accumulated in the protocol. So it exists. It's like a rounding error, but it exists. This money historically have been paid by the Aave-DAO and the safety module if it was not enough, but it were enough until now. And now it will be covered directly by the umbrella stakers in exchange of yield. So we did the math of that. And from the historical data, obviously, past performance doesn't predict the future. But from historical data, someone providing USDC on Aave will gain $3,250 of yield because of the interest rate earned by the protocol for every dollar of bad debt they will have to cover. So it's a pretty good deal from the historical data, but that doesn't mean there's no risk. If we have a catastrophic failure on the protocol, all the good historical data might be overturned by a tragic event. So everybody that is taking should do their own research and understand there's risk involved.
And what is the Horizon plan?
So the Horizon plan is basically Aave is a non-chain protocol, and the Aave DAO is a non-chain organization. But most of the finance is off-chain, still today. And right now, historically, we had very little synergies between the off-chain economy and the on-chain economy. Most of it was for regulation reason and also hostility of regulatory environment of the legacy administration. But everything changed last November. And I have the feeling that a lot of mental barrier changed with the administration we have in the United States. We have some good and some bad. I'm not here to sell that some actors are better than others. But what is true is that institutions that were considering on-chain as not an option before the end of the year 2024 are now considering that an option. And we are seeing the real-world asset market and on-chain presence grow exponentially since the end of last year. And Horizon is the Aave answer to expand in this untapped territory for us. So Aave right now is 70% of the lending market share, 71.2. I checked the data yesterday from Token Terminal. 71.2% market share on the lending on-chain. So we basically own the whole vertical on-chain. But we are the biggest fish in the small pond that is the on-chain economy. But now it's time to explore the ocean, which is the off-chain economy. And Horizon is the focus on that, led by the former Aave companies, known name Avara, and that's the name of their project to explore that.
Yeah, I've definitely been seeing a lot of chatter about tokenized equities recently. We've ended up writing a bunch of features on it. I actually met the Kraken co-CEO yesterday in London. Yesterday or the day before maybe. And he said the tokenized equities will become bigger than stablecoins. So yeah, I do think it's a potential momentum shift for those. In terms of Horizon, what was all the chatter about a potential token? Like, whose idea was that?
That was Avara. I think it was a miscommunication. I wish they talk more to the other service provider of the Aave DAO in order to get peer review and feedback on their initial proposal. They did not, and they went to the proposal to the governance forum with a first draft, and that first draft made a lot of backlash, even from me. I was completely against the first draft and the tokenization of this thing. And I think it's a extremely good proof. And I think that this kind of event makes Aave special compared to all the other DAOs. Most of the DAOs, and I think DAOs get their bad rap in the ecosystem because it's usually like just a decentralization theater. So you have a legacy team, or you have an original team that take all the decision, and then you have the DAO saying yes to everything, and you feel as a token holder completely powerless about what is happening because you don't have a room for negotiation. And I think what happened with Horizon is a clear proof that Aave is the most decentralized protocol on chain today, because the legacy, the original team went with a bad draft, what I will call a bad draft. The community say no way that's gonna pass, and then they just going back to the whiteboard, and they will come back with something better. I think Aave is the only DAO where you can see that. And that makes me extremely hopeful for decentralization.
And why do you think Horizon will succeed in the wake of both Aave Pro and Aave Arc?
Aave-Arc was already a success in onboarding. Given the timeline of Aave-Arc 2021, which was a whole different world in terms of DeFi maturity and also regulatory environment, Aave-Arc onboarded 70 different institutions, some of them quite major ones. And the issue we had back then is that we had a complete segregation on the institutional side, on the borrow side, where we had no trouble finding institution in need of liquidity, willing to cross the Rubicon and go on chain to find that liquidity, and the traditional LPs. And the main issue is that the traditional LP, especially in 2021, they were okay, let's do a proof of concept. Let's deposit 1 million there, see what happened. And that's how we reached $60 million TVL. Back in 2021, that was like something interesting. But how do we go from 60 million to 1 billion? Prove itself 1 billion. That prove itself extremely challenging because the LP side of the institution and the onboarding side of going through custody and whitelisted way to get in and on-ramp on the Ethereum ecosystem was not mature enough. 2025 is a different world. The LP side and the borrower side are more mature now. And also we have a secret weapon in our arsenal now, which is the Go stablecoin. Because when you have a stablecoin, you can, as a protocol, be your own LP. So if you have some lag in the institution providing, let's say, USDC or USDT into your market, you can inject Go liquidity directly into the market in order to be the buffer and the LP on behalf of this institution, especially if you have Horizon Labs, which is a registered off-chain institution that did the legwork to have the regulation in place and the registration to be able to fill that gap on the off-chain world to provide that liquidity and to be the counterparty of this kind of actors. So I have the feeling that we did a good proof of concept in 2021, and now we have all the green lights and all the boxes that are checked to make it a success in 2025.
What do you think of like BlackRock's experiment with Biddle?
I think it's a great one, and I think I will not be surprised that Biddle becomes a large asset inside the Aave ecosystem in 2025.
And you mentioned Go a second ago. I saw that LensChain is using Go for paying gas fees.
Gas.
Yeah. How well do you think the adoption of this stablecoin is doing?
Well, we did 10x in terms of supply in 2024. Our objective is to do 5x in 2025, at least to 1 billion supply. We are in an extreme old style environment in terms of market right now to grow the stablecoin, and yet the Go stablecoin is still growing and doing well. And one thing that is extremely important to consider when we look at stablecoins in the Aave ecosystem is that lending is a low margin business. Because when someone borrows USDC on Aave, 95% or 90% of the interest he will pay go back to the LP, which is completely natural because people provide their USDC on the Aave ecosystem and they deserve to get most of the money. So it's a low margin business because out of the interest paid by the borrowers, which is market related. So in the current market environment, the interests are low. In a more booming market, it will be higher. You take only a fraction of what is paid by the borrowers, and which is completely natural. So lending is a low margin business. And the only reason Aave is so much profitable is our scale. Our scale is absolutely enormous. And because we have a 30 billion size, we have a significant revenue. If you look at everybody else on the lending landscape, they don't make any money. Like if you look at Euler, Morpho doesn't take any cut because they know the revenue they can expect is so low that they prefer to give that back to creators in order to subsidize their business development and externalize their business development. But their revenue is actually $0. because it's a low margin business and it's a complex one. Stablecoins, it's a high margin business because the LP is the protocol itself. So on one go, 100% of the interest rates are paid directly to the Aave DAO. So even if we spend half of what we make in order to incentivize usage of Go, incentivize secondary liquidity to maintain the peg and this kind of stuff, we still make 5 times more than what we make on any USDC. So right now, one Go minted into the Aave protocol is the equivalent revenue of 10 USDC borrowed in Aave. So it's that much profitable. And if we manage to do 5x the supply of Go in the year 2025, that will be half of the Aave DAO revenue. So it's extremely interesting because we have billions and billions and billions of borrowing volumes and acting loans in Aave, but we only have 200 plus million Go borrowed in Aave, and Go is already 10% of the revenue of the protocol. So that's all. That's why we spend so much focus and we are ready to invest. And Aave is the best and the most comfortable situation to create a stablecoins because we have an unfair advantage compared to everybody else. We have the revenue of the other stablecoins. So every dollar we make on USDC, every dollar we make on USDT, on DAI, USDS, LUSD, we can take that money, invest that into Go because 10 USDC borrowed on that side will have the same profit than one more Go. So if I spend the revenue of 5 USDC on the other side to create one more Go in the market, I'm profitable as a DAO. So that's why we spend so much focus on Go. We managed to increase 10x the supply in 2024, and we have the ambition to become a $1 billion stablecoin, to join the $1 billion stablecoin club in 2025. And I think we can achieve that, especially with Horizon initiative and the new initiative we will launch during the year 2025.
Yeah, definitely seems like some sort of judo thing, using your sort of opponent's strength to sort of fund your your growth against them.
Because that's the reality, is that when you are as mature as Aave, when you already are 70% market share, and you will probably reach 80% market share in 2025, that's our objective, and I think I'm confident we will reach that at least in 2025. We spent the 10 previous quarters, like ACI was launched 10 quarters ago, and the 10 previous quarter, every single quarter, we grew the market share of active loans of Aave compared to the lending ecosystem. So we have unprecedented growth, and we have a bigger share of the pie every single quarter consecutively. But if you reach 80% market share, that's not going to 10x your revenue. In our situation, we reach a point of maturity of Aave, and I think it's important to share that perspective because I think people don't realize that. We don't care about the competition of the other lending market. We are competing with ourselves at this point. We are competing with the market share of Go inside the market share of the active loan in Aave. Because the more we grow Go inside the market share of all the stablecoin active loans in Aave, the more we increase our. Because if we 10x the supply of Go, we 10x the revenue of Go. Because it's linear, because we take all the revenue. We don't have to kick back any of the revenue to LPs. So how do we 10x the Aave revenue? The answer is growing Go. That's the simple fact. We don't have to care about getting slightly more market share in DeFi or this kind of stuff. Obviously, we do care, but the most important stuff, what we focus on, our competition, is internal. How do we make Go bigger inside the Aave ecosystem? Because that's how we 10x the revenue in 2025, 2026, and so on.
Yeah. We saw a week ago that Fidelity is potentially developing its own stablecoin. What do you make of that, or the idea of Fidelity and, maybe down the line BlackRock, those sorts of entrants into the stablecoin market? Would that be a sort of new challenger?
As I said, it's not a challenger, it's a judo thing. All of these assets will be on Aave, and they will have their fair, if they have quality and they have a product market fit or potential for product market fit, they have their fair spot on Aave. And we are absolutely stablecoin agnostic in Aave. We have all the other ones, and we welcome them because we piggyback their growth. That's the reality. And the revenue we make on the other ones And because we have this unfair advantage to be the number one protocol in DeFi and the number one 70% market share in Aave, all these stablecoins needs to be inside the Aave ecosystem, and we want to give them the best position and help them to grow, because their growth, we can piggyback it as well for our own growth on Go. So it's not a zero-sum mindset. The more the stablecoin usage in Aave grow, the more Go will grow, and the more Go we grow, the more we multiply our revenue as the Aave DAO. And that's probably something very few people realize in the ecosystem, is that we, at this point, we have an unfair advantage in terms of revenue in our vertical, in the lending vertical.
Yeah, and on a similar note, and you mentioned this earlier, but what do you think about some of the projects doing Bitcoin-backed loans in sort of partnership with exchanges? So, for instance, we've seen Morpho Labs working with Coinbase, where it's it's like a Coinbase stablecoin, Coinbase version of wrapped Bitcoin on a Coinbase layer 2 with like a DeFi project, and then you've got Kraken doing a similar thing with Kraken's layer 2 Inc. and Kraken sort of wrapped Bitcoin. Do you think there's these projects will find success in the Bitcoin-backed lending DeFi space?
I think I'm not at the liberty of sharing everything, but you will see Aave being extremely present in that vertical in 2025 sooner than people think. But we will let people discover that in the Aave Governance Forum when we reach more maturity on this. But we are very close to that. There's also a third actor that you did not talk about, is Tether. Tether is also an extremely large lending actors. It's just that it's not very public, but it's known. Obviously, it's not a secret or hidden, but Tether is a very large Bitcoin-backed loan actors in the ecosystem, and they are willing to be more and more involved on chain, and especially in the EVM ecosystem. So that's something we are also working on.
Why did you choose to expand Aave to the Sonic blockchain? Do you see much sort of potential on that chain?
I have the feeling that the Sonic ecosystem are very close to a DeFi OG roots. I think they get it what the DeFi ecosystem is, and I'm very impressed by the team. We had our relationship up and downs with the Andre Cronje ecosystem back in the days, but I have the feeling that during the time and with the time that passed, we reached a point of maturity on both sides where we can find incredible synergy. And Sonic is one of our largest new networks in terms of growth. And I think we reached number one position there. If not, maybe when people will check this podcast on their platform, maybe it will be the case. But we are soon to become number one if it's not the case. And I think we will become that will be one of the new billion-dollar market for Aave. It's not really a layer 2, it's a different system, but it's a very interesting network for us to develop. And we love all the team handle the growth, the ecosystem, and the way they manage to reach scalability.
Moving on to sort of Ethereum more generally, despite the sort of price action of the last year, you seem very bullish on ETH, or at least sort of Ethereum more broadly. What's your sort of reasoning there?
It's I don't it's an interesting question. Bullish on the ETH asset. The thing is that it's the least worst alternative we have if we're looking into it. And we have completely centralized layer 2s right now. I have nothing against the base ecosystem, but it's a completely centralized network, and everybody pretending it's not is lying at this point. We have the Solana ecosystem, which is extremely centralized as well, and has issue of reliance of the network. Like the thing you don't want for a lending protocol, it's very important to understand the mindset of lending protocol is that you need liquidator to show up if things go south. Because if you cannot process transaction when the value of collateral go down very sharply, when the blockchain reach back uptime and then you can proceed blocks, maybe it's too late. And the value of collateral, your collateral is below the value of debt. And that's how you end up with bad debt, and that's how you end up in the red, and basically the protocol is dead. So the ability and the trust that you will have a block in X amount of time, and you can trust that, is extremely important when you have an ND protocol. Probably more for us than anybody else. Because if you are Uniswap and people cannot trade for 2 hours, who cares? They will trade after. Or maybe they will be unhappy because they want to sell tokens and the value of those tokens will go down, but they're not going to lose like the protocol will not die. Uniswap is at no risk of dying if you do that. If you cannot proceed any transaction, any liquidation for 2 hours on Aave, maybe Aave will die. So it's extremely important. And I think Solana is much better in 2025 than it used to be in 2022, especially 2023, where the blockchain was down every other month. But it's still hard for us to have this level of trust. The perfect system, I think, will be the Ethereum Foundation realizing that you can scale better. You can increase the block size, reduce the block time into the Ethereum layer 1, and nothing bad will happen. And I wish they would leave the ivory towers from their Berlin loft or whatever they live, and they realize that the EVM ecosystem is the most fork ever. Like, you have so many EVM chain that tried every crazy shitty parameters of that. You have like Gnosis that did 1 second block time. You have BNB that did crazy high gas limits, this kind of stuff. You have Polygon POS that also experimented to many stuff. And you have years and years of data of alternative EVM, of what is happening. And you don't see those chains die. You see them proceeding blocks. And you see what works and what doesn't work. You see that when polygons go too crazy, sometimes they have like 60, 90, 120 block reorgs. You probably know, okay, let's not replicate that. That's maybe a bit crazy. But you have a clear understanding that where you can go, and you have these laboratory in the wild, like people testing prod parameters. So I wish, I think the roll-up centric approach was a mistake. Not pricing the blob data was a mistake as well, because right now Coinbase is making a lot of money and don't contribute a lot to the Ethereum layer 1, and that affect the economics of the ETH ecosystem. But the good news is that you can adjust that. You can do some soft work, you can work on new design, and you can scale the Ethereum layer 1 to make it more interesting. You will never be as performant as those crazy centralized chains, but you can reach a soft spot where you have a user experience that is more attractive. You have a scale that make it also more sustainable if you want to grow the on-chain economy. And that's something I wish we explored more. But I have the feeling the Ethereum Foundation is inside a new paradigm and a new dynamic for the past few weeks. We had a change of leadership. We have etherealized. We have more open-minded people and more listening to the community. So I will not kill Ethereum just yet. Maybe there's things to do on that side. But I will say that I'm not very satisfied with the current state of Ethereum mainnet right now.
But would you say that we should focus more on like building and using on mainnet instead of sort of like layer 2s? I mean, right now it seems to be everything's going so far towards layer 2s. You've got app chains like Unichain.
I think that's a mistake. I think the most should be happening on mainnet. And when you look at the economics, 90% of the money Aave DAO makes is still on mainnet. Like, if you look at the other chains, we had big success on Arbitrum, on Optimism, historically on Polygon. We have a big success on Sonic. We have a good ones on Avalanche, on Base. We have good success there. But all of that combined, and it's $1 billion markets, all of that combined, still less than 10% of our revenue. So I have the feeling that if you decrease the block time from 12 seconds to 5 seconds and you double the block size, nothing bad will happen in terms of the infrastructure, but you will need much less those layer 2s, and you will have a great experience on layer 1. So I'm not sure these experiments of having 70,000 layer 2s, extremely fragmented liquidity, a terrible bridge experience, a crazy bad UX into your wallet where you have to switch RPC on this kind of stuff, was worse the actual outcome we got.
Interesting. The other day you tweeted you think the Ethereum mainnet has scaled and become cheap enough to make the L2 value proposition obsolete without a genuine competitive edge. Like, do you think that Ethereum has scaled enough, or is it that fees are down because we're not seeing, for instance, huge bursts of demand at single points in time, and that, you know, there is some volume has moved to layer 2s and other networks like Solana?
The reality is that the low value volume, low added value volume that you use to be on Ethereum layer 1, like crazy ICO, like Ponzi schemes or casino trading, this kind of stuff, it moves to layer 2 and Solana. That's completely clear. But the actual economic activity is still mainly on layer 1. Yeah, if people want to move $10 million on chain, they will do it on mainnet today. They can do it on Base, and that's one of the unfair advantage, like competitive advantage I was talking about layer 2s. I think Base, because of the proximity of the Coinbase ecosystem, has a value proposition in itself that makes it interesting. That's why BNB or BSC did not die during the past bear market. They have their own community because they have this proximity with the Binance ecosystem, which is an unfair advantage for them. Arbitrum, they have this first mover advantage, being one of the first L2, very large community. They do things right, so they will stay there. But what's the added value of something that was funded by VC in 2023 and was released last year? I'm not sure, and the market is not sure as well when you look at the valuation and the directionality of this valuation. So you need those unfair advantage and a competitive advantage to stay relevant on the layer 2 space. Otherwise, what's the point?
How would you sort of fix this? Like, let's say if you were sort of in charge of all of Ethereum, you could do whatever you wanted. How would you sort of fix the dynamic between like mainnet, layer 2s, the fees, that sort of thing?
I think one thing that is important is to break the ivory tower where most of the EF researchers live right now. They live in a fantasy where you need to have a dApp nodes. For everybody running Ethereum, we have their own dApp node at home on a 8 megabyte Berlin retail internet broadband. And that's all the second biggest on-chain economy should be run on. I don't think that makes sense. And I think you can scale, and you can have today, like I have 2 gigabit fiber at home, and I'm a retail. I have with $1,000, you have hardware that is extremely performant that will allow you to run thousands and thousands of validators. And I do that, for example, on Gnosis. Like I run thousands of Gnosis nodes on retail hardwares. And it's a 1 second block time, and it's a block size limit that is much larger than Ethereum mainnet. So we need to start with the fantasy without having to compromise to be just 20 validator like on BNB, completely centralized, and all of them is CZ and CZ with a mustache, or whatever amount they have on Solana with like 100K a quarter cost or whatever it costs, like crazy industrial grade hardware that you need to run the blockchain. There's a sweet spot in the middle. I mean, have you looked at the Mac Mini? Like, put a fucking SSD 40 terabyte on this new Mac Mini that are extremely performant, and you will have like a very good hardware. Like the base set of obviously that's a suggestion. I'm not saying like it will be a good node, but it's a retail suggestion. There's way to scale and scale now without compromising on security and without compromising on decentralization. We don't need fucking nodes in Timbuktu or whatever. Obviously, if some people in Timbuktu want to run nodes, that's great. And if they can't, and if they have the infrastructure, and I think you can find the infrastructure there to do it, but we should not have the second largest on-chain economy to slow down because maybe someone in the countryside of Nepal would not be able to follow. Oh, come on, guys.
All right. Well, that's all we have for today. I want to thank Marc for joining this episode. As a reminder, our newsroom works tirelessly to get you accurate, informed crypto news. If you want to stay ahead, make sure to read the blog. Thanks, and see you next time.